Imagine you wake up tomorrow. You grab your phone, and the headline reads, World War III has officially begun. Your first thought probably isn't geopolitics. It's not flags or borders. It's what happens to my money, your savings, your $41,000 at your mortgage, your job, that $47,000 sitting in your brokerage account. Is it still there? That $2,200 a month you're putting toward retirement. Does that still matter? Because the answer is not what most people think. And by the end of this video, you're going to understand exactly what happens to your money when the world goes to war. Stay with me. This is going to matter. Before we go anywhere, let's agree on something. This isn't a doomsday video. This isn't a prediction that World War III is coming tomorrow. Because understanding what war does to money is one of the most important things you can learn. Not because war is inevitable, but because the economic forces that war triggers are the same forces you need to understand right now. Inflation, market crashes, currency devaluation, asset flight. These things don't only happen in wartime. They happen every decade in major financial crises. And the people who understand them in advance are usually the ones who come out ahead. So what we're going to do today is walk through the financial playbook of a global conflict, step by step, dollar by dollar. And by the end, you'll know exactly what disciplined investors do and what panicked investors do. Let's start with the moment it all begins. The market open, the day after. Quick pause. This video is for educational and informational purposes only and does not constitute personal financial advice. Now let's get into it. Picture the New York Stock Exchange. Monday morning, 9:30. Traders are walking in. Computers are turning on. And then the news breaks. Within seconds, sell orders flood in. Millions of them, all at once. And the S&P 500, the index tracking the 500 largest companies in the United States, starts falling. Now, how far does it fall? That depends. But here's what most people never hear. Every one of those markets eventually recovered. Some faster than others. But they recovered. The real question isn't what happens to the market on day one. The real question is what happens to your portfolio while everyone else is panicking. Let's say you have $80,000 invested in a typical portfolio. 70% stocks, 30% bonds. In a severe panic, that portfolio might temporarily drop to around $60,000. $20,000 gone, at least on paper. And when you see that number falling in real time, it feels very real. That feeling is powerful. Powerful enough to make millions of investors hit the sell button at exactly the wrong moment. But before we talk about that reaction, something else is happening inside the market. Three forces hit simultaneously. First, panic selling. Individual investors rush to liquidate positions. Index funds, exchange-traded funds, individual stocks, anything that can quickly turn to cash. Second, institutional repositioning. Large investment firms move billions of dollars from riskier assets into safer ones. Third, algorithmic trading. Automated trading systems detect momentum shifts and amplify moves in both directions. The result? Wild volatility. A market that drops 4% in the morning, recovers 2% by midday, then falls again by the closing bell. Fear spreads quickly. The VIX, often called the market's fear gauge, spikes. But this is where things get interesting. Not all stocks fall. Some rise, sometimes dramatically, and knowing which ones before a crisis begins can make an enormous difference. We'll talk about those sectors later. But first, while markets are reacting, what's happening at your bank? Let's talk about your bank account. The one with $12,000, maybe $30,000, maybe even $80,000. Is it safe? The short answer is usually yes. But the full explanation is more interesting. Banks operate using something called fractional reserve banking. This means they keep a portion of deposits available as reserves while lending the rest into the economy through loans and investments. That's how mortgages get funded. That's how businesses borrow money. That's how economic growth happens. In normal times, the system works smoothly because not everyone asks for their money back at the same time. But in a crisis, sometimes they do. This is called a bank run. And today, bank runs move faster than ever. But there's something important many people overlook. Even insured deposits can sometimes become temporarily inaccessible while the financial system stabilizes. Not gone, not confiscated, just temporarily restricted. So what do cautious investors do? They diversify where their cash is held. They know how much of their deposits are insured, and they maintain a small physical cash reserve at home, usually something modest, perhaps $2,000 to $5,000 in small bills. Not because the system is expected to collapse, but because preparation reduces stress in uncertain moments. Now, while banks are stabilizing, another force begins hitting households almost immediately. And this one shows up somewhere very familiar. Your grocery bill. The first place many people feel economic stress isn't the stock market. It's the grocery store. During World War II, governments introduced rationing systems. Gasoline, sugar, meat, and other goods were limited through ration books. Why? Because war disrupts supply chains. Shipping routes change. Factories shift production. Transportation costs surge. In today's global economy, supply chains are even more interconnected. The average American family spent roughly $460 more each month on basic goods compared to the year before. $460 every month. In a prolonged global conflict, those pressures could intensify. Energy costs rise. Transportation becomes more expensive. Food supply chains tighten. Gasoline prices that were $3.50 per gallon might climb to $6 or even higher in extreme conditions. Groceries, utilities, housing costs all feel the pressure. And that's when people start asking a different question. If cash is losing purchasing power, where does money move instead? Because inflation doesn't destroy money. It moves it. And that brings us to assets. When financial systems become unstable, investors search for stability. Money flows out of high-risk assets and into what investors call safe havens. One of the oldest safe havens in history is gold. Gold has been used as a store of value for thousands of years. Unlike fiat currencies, its supply cannot be expanded quickly by governments or central banks. During periods of uncertainty, demand for gold often increases. Another category is commodities, energy, agricultural products, industrial metals. War disrupts supply, and when supply drops while demand continues, prices often rise. Energy producers, commodity exporters, and agricultural businesses can benefit from these shifts. Real estate is another interesting case. Physical property is a tangible asset. During inflationary periods, the real value of fixed-rate debt can decline over time while the asset itself maintains value. And then there's the digital wildcard, Bitcoin. Bitcoin was designed as a decentralized digital currency operating outside traditional banking systems. Some investors view it as protection against currency restrictions or financial system instability. However, cryptocurrency markets are also volatile. During sudden market shocks, crypto prices can fall alongside other risk assets before stabilizing. So while some investors use it as a hedge, it remains a higher risk component of a portfolio. But while some assets protect wealth, certain industries actually grow during conflict. Understanding this next part is important. Not because anyone wants conflict, but because markets respond to incentives. One of the most obvious sectors is defense. When governments increase military spending, contracts flow to companies that manufacture defense equipment. Energy companies can also benefit when global oil supplies tighten. Fuel powers transportation, logistics, and military operations. Cybersecurity is another growing sector. Modern conflicts increasingly include digital attacks targeting infrastructure and financial systems. Companies specializing in digital defense become critical. Healthcare and pharmaceuticals also play essential roles. Medical supplies, treatments, and emergency response systems are all part of wartime logistics. Again, none of this means investors should build portfolios based on predicting conflict. But understanding sector rotation helps explain why markets behave the way they do during crises. Now, let's talk about preparation. Preparation begins long before a crisis. The first step is building an emergency fund. Financial planners often recommend 3 to 6 months of living expenses in accessible savings. If your monthly expenses are $4,500, that might mean maintaining somewhere between $13,500 and $27,000 in liquid reserves. This cushion prevents investors from needing to sell long-term investments during market downturns. The second step is diversification. Spreading investments across multiple asset classes, stocks, bonds, commodities, and international markets reduces concentration risk. The third step is rebalancing. When one asset class drops significantly, disciplined investors gradually shift their portfolios back toward their original allocation. This often means buying assets when they are unpopular. Historically, that discipline has rewarded patient investors. The fourth step is long-term thinking. Market crashes feel dramatic in the moment, but over decades, markets have consistently recovered from crises. And the final preparation involves protecting against inflation. In the United States, Treasury inflation-protected securities, often called TIPS, adjust their value based on inflation rates. These instruments aren't designed to generate enormous returns. They're designed to preserve purchasing power. But even with all of this knowledge, one obstacle remains: human psychology. Human beings evolved to react quickly to danger. Thousands of years ago, rapid reactions helped our ancestors survive. But those instincts don't always work well in financial markets. When investors watch their portfolio fall from $80,000 to $58,000 in a short period, the instinct is to escape the loss. Sell. Move to safety. But in markets, that instinct often leads to the worst possible timing. Studies in behavioral finance show that many investors consistently buy when markets are rising and sell when markets are falling. During the 2020 pandemic crash, markets dropped roughly 34% in just over a month. Many investors sold, but within months, markets recovered and continued climbing. Those who sold missed the recovery. So how can investors resist panic? One method is creating a written investment plan before crisis occurs. If you decide in advance how you will respond to market declines, you're less likely to react emotionally in the moment. Another strategy is limiting constant exposure to financial headlines. Short-term news cycles amplify anxiety, but rarely change long-term investment strategies. And finally, focus on what you can control: your savings rate, your diversification, your emergency fund. Preparation doesn't eliminate uncertainty, but it makes uncertainty manageable. The world has faced major crises before: world wars, financial crashes, economic recessions. Each time, markets were shaken. Each time, economies adapted. And each time, the investors who stayed disciplined were the ones who came out stronger. You don't need to predict the future to protect your finances. You simply need to understand how money moves during uncertainty. Because the real question was never only, what happens to your money if a global conflict begins? The real question is whether you're prepared for the economic shocks that history shows us will eventually come. Preparation, knowledge, and discipline have always been the most powerful financial advantages. And those advantages are available to anyone willing to learn. Thank you for watching. If this video helped you think differently about money, share it with someone who might benefit from it. And I'll see you in the next one.